Hello and welcome to the Retire to a Life You Love podcast with your host, Michelle Gessner. I'm Wendy McConnell. Hi, Michelle. How are you?
I'm good. How are you doing?
Oh, I'm good. It's always so nice to see your face.
Oh, thank you, Wendy. It's good to see you too.
Oh, okay, so today we are going to be talking about the 4 myths and misconceptions of long-term disability insurance and why you should care.
Yeah. We're gonna talk about a subject that some of our listeners may be thinking, "Oh, that doesn't really apply to me because I'm already in retirement. I don't have long-term disability insurance, and I don't need it because I'm not working anymore." But before you think that, or conclude, I should say, that this episode does not apply to you, um, you may want to think again. And the reason I say that is even if you're no longer working, you may have a loved one who needs this information. Or maybe you have a loved one who this does impact. And if financial disaster strikes them, you would step in financially. So indirectly, this episode may pertain to you.
So one of the myths could be that your company offers benefits for this. Is that something that you hear often?
Yeah, so a lot of companies do offer long-term disability insurance, and that's not a myth. That's true. But the myth is that the benefits are enough. That could be untrue. And the reason I say that is because many people don't even bother to look at their company benefits. And if they were to look at them, they don't understand them. Long term disability insurance is one of the least understood kinds of insurance policies. So people just don't understand what they have. And this even applies to folks in HR. So you might go to your HR department and they don't even understand the terms of the policy. So it's a problem. Now, I'm going to cover with this company benefits thing. All right, so you have company benefits and you know that you have the long-term disability. And usually what people understand is, oh yeah, and it pays 60% of my salary if I become disabled. Okay. And that's the extent of what people understand about their long-term disability. But there's so much more to it than that, that it becomes dangerous if you don't really know what you have, because you might have a huge gap and not even know it. For example, um, I'm gonna cover the 60% thing first. Yes, your policy may provide you with 60% of your base salary, but only up to a very low monthly cap in certain cases. Okay, what if you bring home, say, 15,000 a month, but your benefit cap is only 5,000? All right, 60% of 15,000 is whatever, and it's probably over that 5,000 cap. So, if you don't understand that you have a cap, you got a problem right there. Another issue with that is, let's say most of your compensation comes from a bonus, or some sort of commission, not from a base salary. Did you know that these disability policies often are talking strictly about the salary, the base salary? So when they say, yeah, we give you 60% of your compensation, it's your base salary. So if you're a high commission or bonus paid person, 60% of your base salary isn't going to cut it.
And
So it's
overtime.
yeah, overtime. So there's a lot to really understand. The monthly cap is a big gotcha. You've got to know that if you have that. I had a client years ago where that was a real eye opener. He was an engineer. He thought he was covered, but the cap was so low, which, fine print. He never read it. He did not know that it was basically a worthless policy to him.
Wow.
Also, the definition of disability. Here's another one. Do you know how they define disability in your company policy? Because these group policies often use these very standard definitions that say, okay, you're going to be considered disabled if you can't do the material aspects of your job within the first 2 years of your disability. But then after that, you have to be totally disabled and unable to work at any kind of job to be able to continue to collect.
Okay, so if you're a laborer and
Hmm.
you've hurt yourself, you've hurt your back, let's say,
Hmm.
and you can't do that job for the first 2 years, that's okay, but just for the fact that you could sit at a desk prior after 2 years means that you won't be able to get the benefits anymore.
That's right. That's a very good example. Yes. So it's important to understand what the definition is. Now, I'm just giving a common definition you'll find in a lot of group policies, and they call that in the vernacular. They call oh uh, 2 years of ONOC, and then after that, any OC, and OC is the obviously the abbreviation for occupation. So, yeah, you got to know what their definition is. And some of them are very broad definitions, which would be good, and some of them not so much.
So you can go ahead and, purchase additional? Is that what you can do?
Yeah. So let's say you've gone through the details, and and you don't like what you're seeing. It's not, like my engineering client. It just isn't going to cover the situation. Well, you can purchase on your own a small long term disability policy that supplements your work disability policy and has maybe a better definition of disability. Now you own this thing and it goes with you wherever you go. So if you leave your company or your company benefits change, or let's say you stay at the company, but you've got this supplementary policy that you now have for protection. Another thing I wanted to point out that I don't think I mentioned, people understand some of the terms. One of them, obviously, is it's a 90-day policy. That means that you have to wait 90 days after the initial illness or accident before the benefits kick in. But what they don't understand is the term they may read in the fine print that says elimination period. Well, elimination period is the waiting period. That's all it means. It's just that, again, there are terms that just people don't understand, and that so they just don't bother to really pay attention.
And that's probably on purpose, right?
Yeah, I mean, look, and it's not a fun subject to think about, but protecting your paycheck, that's what we're talking about here.
Yeah. Okay, so another myth is that, I'm not that risky. I don't go bungee jumping or flying out of airplanes or stuff like that, jumping out of airplanes. So I don't really need disability insurance.
Yeah, so that is a common misconception that, okay, you live a risk-free lifestyle, therefore it's not really a concern that you need to have. But here's the thing, it's not necessarily an accident that could cause you to be disabled. So you spend your days at a desk job, you're not doing anything risky, you don't boat, you don't ski, you don't bungee jump like you mentioned, you don't hunt, you don't do anything dangerous, but actual disability claims data show that the majority of claims are due to illness, not accidents. So, yeah, I mean, if you're a human being, you need to pay attention, right? The
Right.
number one claim for, or number one reason for a claim is um, this fancy term that I can barely say, musculoskeletal disorders. That's the number one reason for a claim. What is that? Okay, back issues, right? So people have back injuries. That's a very common reason for a claim. Number two is cancer. Number three is injuries from fractures, sprains, muscle strains. And number four is mental health issues like depression. Number five is circulatory issues like heart attack or stroke. So far, I've given you the top five uh, most common claims for disability. Did you hear me say anything about an accident?
No, no getting hit by a bus or anything like that. That's typically what we think of, when we're thinking about an accident.
Sure. And okay, you could argue that the number three that I mentioned, injuries from fractures, sprains, and muscle strains. Okay, maybe you got that from an accident, but cancer, heart attack,
Yeah.
back injury. Sometimes hear of people who have lower back problems, and it had nothing to do with anything that they did. It's just degeneration of some, the spine. So it's not necessarily your lifestyle that you have to worry about.
So what if I take the point of view that, and this would be another myth or misconception, is that, well, I'm going to have the money to handle the situation if that happens to me.
Right. Okay. Yeah. So now let's jump to that myth. I have the money. Something like this happens to me. I'm good. All right. Remember, this is long term disability we're talking about. We are not talking about short term disability. Short term disability is just how it sounds. It's a short term situation. You're going to recover. You're going to go back to work. But if your claim is for longer than 90 days or 180 days, some of the disability policies out there have you waiting 180 days before benefits pay. Okay, so if you're talking about a long-term situation, that's not necessarily something insignificant to forget about. Think about your paycheck. Think about how you depend on it to pay your bills, save for your retirement, save for your kids' college education. Maybe you're the primary or sole breadwinner. Now let's take your paycheck away for a year, 2 years, 3 years. Maybe if you're disabled, you're going to need some more medications and maybe some home modifications depending on what the disability is. What would this do to you financially? That's what we're talking about here. The math is pretty awful once you look at it. So not necessarily the case that you have the money if this were to happen to you. I'm gonna refer to a study that was done. There was a 2019 study of bankruptcy. So they looked at consumer bankruptcy filings, and they found that 78% of bankruptcies were attributed to loss of income as the main contributor. And of that 78%, 44% were because of medically related work loss. And cancer patients were almost 3 times more likely to go bankrupt than people who didn't have cancer, with cancer patients under the age of 50 having the highest rates of bankruptcy. So these are ugly, ugly statistics. But the reason I'm bringing this up is as a financial planner, my job is to make sure my clients have a high probability of success to retire to the life that they love. And we can't control what happens to us. We can't control life, right? So what we can do is look at the gaps, look at the risks, and then try to do whatever we can to mitigate those risks. So if you're thinking, okay, I'm convinced, you don't have to say anymore. I'll go out and just get one of those policies that covers those medical expenses not covered by health insurance. Well, that's not what I'm talking about. That's a fraction of the problem. So I'm like, you hear those commercials for Aflac and those types of policies. Those are not disability income policies. Those are not long-term disability policies. Those are just paying for the part of your medical expenses that are not covered by health insurance. Those are not replacing your income. What you really need in these situations is an uninterrupted source of income. And that's what disability insurance does.
What about Social Security? I mean, you don't you get that if you're disabled?
That's a really good point to bring up. Yeah, Social Security can be in the picture for you, but it doesn't really help for most people. I want to give you some information about that. Did you know that only a third of Social Security applications are even approved?
Hmm.
And here's why. Their definition of disability is so strict. I have a blurb that I pulled off their website that I want to read to you. But before I do, they don't give you partial disability benefits. They don't give you temporary disability benefits, which, by the way, partial disability is much more common than total. Um, they don't do anything if you're partially disabled or temporarily disabled. And many of the applications that they receive, they make them go through an appeals process. So they're first denied, and then you have to go through an appeals process, often waiting about 9 months to get an answer. Now, I told you only a third are even approved. So you got some hoops to jump through. And if you're approved, the average Social Security disability income benefit is only $1,279 a month, which is $15,348 a year well below the poverty line for a two-person household.
Yeah, for sure.
Now, if you're thinking, oh, well, workers' comp, that'll help me. Well, according to that same study, less than 1% of American workers missed work because of an occupational illness or injury. So I want to give you that onerous Social Security disability income definition. So I am literally going to read this. It's just a couple of sentences. A person is disabled under the act, then they're talking about the Social Security Act, if they can't work due to a severe medical condition that has lasted or is expected to last at least 1 year or result in death. The person's medical condition must prevent them from doing work that they did in the past, and it must prevent them from adjusting to other work.
So again, if you're a laborer and you did physical work, if you can sit at a desk, you will be expected to do that.
That's right. Yeah, they don't care. So they have an any occupation definition. So you only get Social Security, you only qualify for Social Security disability income if you cannot do any occupation. That's their definition. And the part that you may have missed or may not have thought about is you have to prove to them it's going to be permanent, that it's going to last at least a year, and or result in death. So they're just not handing out Social Security disability checks.
No, they wanna make sure that they hang on to those as much as they can, right? But what if
Right.
you're 25? You're like, "Come on, I'm 25, I'm young, I don't have to worry about this."
Right. Yeah. So for our retirees who are listening to this episode, pay close attention because this may be your grandchildren, this may be your children. So young folks are not thinking about long-term disability policies. Why should they? Right. That's the furthest thing from their mind. Um, Well, okay, I will give them this. The data that I just talked about, the claims data, you're much more likely to have something like this happen when you're 50 or older, for sure. The claims data are illness related, and health at 50 is not as good as it was at 20. So, from that standpoint, the 20 somethings are right there. However, here's what you got to know: if you're young and healthy, that's exactly the right time to lock this coverage in place. Why? Because it can be locked in. So it doesn't, once you lock it in, the price doesn't go up. Okay. It's locked in at age 26, if that's how old you were when you bought it. And it's age based pricing. So you can also add a rider to your policy that allows you to increase your benefit as your income grows. Maybe you're not making as much at 26 as you're going to make at 46. Of course, you're not, right? So you can't qualify for the higher benefit at 26. You can qualify for the benefit for which your income allows you to get, but you can put that rider I mentioned on the policy that says, "Hey, as I make more money, if I want to add more benefit, I can do that and I don't have to prove I'm still healthy. You can't even look at my health." That's what I'm talking about. If you wait until you're older, that's just not the smartest thing to do. Lock it in. Look for a policy that is guaranteed renewable and non-cancelable. And that non-cancelable quality or characteristic, all that means is that the company cannot cancel it unless you fail to pay the premiums. Doesn't mean you can't cancel it. They can't.
Okay, so what about if, all right, 25 now, and say I didn't start till I was 50. Don't I save as much money from not having to pay the premiums for the next 25 years?
Oh, sure. You're not having to pay those premiums for those 25 years, but those are tiny premiums. You should see the difference between a premium at age 25 and a premium at age 50. The difference is huge. So you're not saving that much. The number one. Number two, you're assuming, Wendy, that you can get that a good policy, the one you want at age 50. You may not qualify. Maybe your health isn't that great. Maybe it's okay, but what people don't realize is this is not the easiest policy to get. You will have to go through underwriting, medical underwriting. And if you don't have perfect health, you may qualify to get a policy, but it may be more expensive. They add a surcharge if you have a health issue, or maybe they have a claim that something is excluded, a health condition is excluded. So it's just not. I can't think of any good reason not to lock it in when you're in your 20s.
Okay. Got it.
Yeah. So, all right. One more. Can you stand another statistic, Wendy?
One more statistic, and then that's it. I'm putting my foot down.
Okay. So, according to a Social Security Administration report, now this is about 20-year-olds. This was published in June of 2020, and all these statistics, I'm going to have a link in the show notes so you can look this up for yourself if you want to. So, in June of 2020, they had this report for someone born in 2000. The probability of becoming disabled between age 20 and normal retirement age, which is age 67 for that person, is 25%. And the probability of dying between that same age and normal retirement age is 13%. So, what that means is you're twice as likely to become disabled before you retire than die before you're retired. Also, I hear that 25% quoted differently. 1 out of every 4 20-year-olds will experience a disability claim of some sort sometime before they reach retirement age. So that's the data. That's the statistic of frequency.
Yeah, that's a lot.
Yeah. So I urge people to think about this type of coverage. And yes, you may have it at work and it may be a great policy, but you should look at it. We look at these policies for our clients and make sure that they have what they think they have. Yeah, I've given a lot of bad news to think about, but the good news is if you're in decent health, you can cover this gap with a long-term disability policy. If you need to go out and get one on your own, because your work policy maybe isn't that good or because you change jobs a lot and the price doesn't go up as you age, and your health can change. It doesn't matter if your health changes as long as you've locked in the policy. And you can add that rider to protect the future income that you may need to protect. And you definitely do not want to assume anything when it comes to health. Health is a wild card. It can change overnight as we age, so we must never take it for granted.
Yeah, and we have to think about, especially when it comes to health and costs, how much healthcare costs. So, in addition to lack of income, you're
Oh,
also
yeah.
going to have a lot more expenses.
But how are you going to pay for that health care if you don't have the income? So we're talking about protecting your income.
Yeah, absolutely.
Yeah, so get the professional help that you need. Make sure that you're getting your advice from someone who has experience in this area. A lot of advisors do not, even CFPs, they don't have experience here. At our office, we run the numbers. We look at what your financial plan says. We review your benefits. We explain them to you. We look at all the fine print, which is found in the summary plan description, which a lot of companies do not give their employees unless it's upon request. And we will help you with your options if you need it. You may be fine with your regular policy. So again, if you're already retired and it worries you that your adult children could be at risk or don't understand what we are talking about, just forward this podcast episode to them and make sure that they have a listen.
Yeah, just locking in that lower cost, that lower premium is, sounds like a great deal.
Absolutely. Yep. I'm passionate about that.
Yeah. So if somebody has some more questions about this topic or anything having to do with financial advice, how do they get in touch with you, Michelle?
Yeah. So just visit our website, GessnerWealthStrategies.com. The contact information is right there. You can reach out and we will be happy to help you however you need.
All right. Sounds good. And thank you for listening today. Please follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to Retire to a Life You Love with Michelle Gessner from Gessner Wealth Strategies. We hope you were inspired to take steps to your financial freedom as you learned new techniques and strategies for managing your finances. To learn more about how you can improve your financial landscape, visit our website at www.gessnerwealthstrategies.com. That's GESSNER wealthstrategies.com. Or give Michelle and her team a call at 713-589-6448. And don't forget to click the follow button below to be notified when new episodes are available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Michelle Gessner or Gessner Wealth Strategies. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.